European financial markets are trading firmly higher this morning, with the UK's FTSE 100 index currently up around about 67 points, the DAX in Germany up 127 points, and the Euro Stoxx 50 index currently up around about 38 points. US stock futures are also doing pretty well. The Dow Jones Industrial Average front-month futures contract is up about 38 points, while the corresponding S&P 500 contract is up around about 3 points. In the commodity space, gold is currently up about $8. Core government bonds are lower, that's German bonds and UK gilts, and the US dollar is softer while the euro is stable and the yen is picking up some steam. Good morning, I'm Ishaq, Siddiqi, and welcome to your daily market bite. I'm going to give you guys a quick idea of what's going on in financial markets today. So today we are firmer across the board, and that is on expectations that we are going to get a very dovish Janet Yellen when she speaks to Congress in her first testimony in front of Congress today. Now she is the new Federal Reserve president, taking over from Mr. Ben Bernanke, and Janet Yellen and her Yellenomics policy framework, which is expected to be implemented in the Federal Reserve, is likely to be a loose monetary policy strategy in which ultra-low interest rates will be reaffirmed for a prolonged period, and at the same time the tapering of quantitative easing is likely to continue. Now, the problem here for Janet Yellen is that she's going to have to dust the snow off a lot of the data points that we had from the US. Clearly, some of the data that we've seen in recent weeks suggests that the US economy hasn't been as strong as many people expected for the start of 2014. Now, of course, severe weather effects in the US, particularly in the eastern seaboard with the polar vortex, have sapped a lot of activity when it comes to industrial production, also manufacturing activity. We saw a poor US ISM number from the manufacturing side, although the services sector continued to expand. At the same time, we have to remember that the US labour market, the key indicator for the Federal Reserve and their monetary policies, is now starting to show signs of waning. Last week's payrolls number was not as great as people expected, around 113,000 jobs to be created by, or 113,000 jobs created by the US economy, rather than the 185 that was expected by the market, and that comes off the back of the report for the month of December, in which the US only generated somewhere around 73,000 jobs for the month. Now, the unemployment rate has been edging lower. It currently is at 6.6%, which is very positive. We know that the Federal Reserve was looking at 6.5% as a level to firmly let go of QE, but they're going to have to reaffirm guidance now, revamp it in certain ways, particularly with the thresholds when it comes to unemployment, and build up some credibility back into the Fed, and also at the same time quell some of the concerns about the market, perhaps hint at a possible rate hike, even though it's very unlikely that they will do so. And more importantly, for a lot of people in the market, we want to hear a little bit about what the Federal Reserve has to say about the rap in the emerging market space, which has seen a wipe down of emerging market assets. So that's the thing to look out for. There's not much else on the economic data plate today, and on the corporate agenda, it's been very thin on the ground. Barclays came out with their fourth quarter earnings, which were very poor, showed an 86% slump in pre-tax profits, and at the same time continue to show a decline in their investment banking operation. That was in contrast to some of the controversial moves at the bank by the CEO for raising bonuses. And continue to reward bank managers within the firm with high salaries and bonuses and compensation, and that's going to be very much in scrutiny by the public, shareholders, and the market alike, and that's something that's really putting pressure on the stock price at the moment. That's all for your daily market bite. Tune in tomorrow for another one. Cheers.